Hi, welcome to this video today. It is the 13th of November. It's Tuesday, 7:30 p.m. GMT. Just going to look at what we consider to be a really great risk-reward trade setup, which is Euro NZD. And we looked at it last week. We wanted to buy it, and it fell away to the downside. Now, what we're going to do today is look at a simple entry technique to catch market reversals. As the euro has fallen, in our view, the probability of a rebound has increased, and the risk to reward now is even better. Could be as much as 5 to 1. We expect it to be at least a 3 to 1 in terms of what we get out of it to what we risk. Okay, now in terms of this trade setup, it's very simple to understand. So let's go to the chart of Euro NZD and look at the trade setup.
Right, we're on the chart of Euro NZD daily, and as you can see, the euro, after topping out up here, moved down sideways in a big fall down, well over 1,300 pips, and I think the odds of a bounce higher now are very, very high. Fantastic risk to reward, in my view. Now, in terms of before I draw my levels, just want to discuss the reason for the strength in the NZD. It's not just strengthened on the euro, it's strengthened everywhere. It's a short squeeze. Now, when you get a short squeeze, you normally get a really good retracement, and I'll just explain why. Just written some notes in the top left-hand corner. Market heavily short the NZD. RBNZ, Royal Bank of New Zealand, calls New Zealand's strength across the board by indicating they probably won't cut rates. They'd said that in their statements before. They might have to, but they said they probably wouldn't now. But also no rate rises until 2020. Well, that's bearish. But this here is a peaking of the bearish fundamentals in the short term. Market just so short the NZD. And the short squeeze is just simply when sellers exit a market, and when they exit their shorts, they have to buy back the Kiwi. This is not all to do with Kiwi buying, okay? It's short sellers, people who are short the Kiwi, just basically buying back, okay? Now, these types of moves will retrace a good portion, in my experience. And what you get effectively is when you top out here, it's a gentle fall sideways, then the accelerated fall. It's the accelerated fall that will probably be retraced. Now, if I draw some levels, you've got a double bottom there just below the let me make that line straight, just below the 166 level, okay? Sorry, I haven't got it straight. And that is actually a level on the weekly chart where, let me just get rid of that line, weekly chart where the Kiwi has basically failed to penetrate on a close basis. Okay, so just below the round number will provide support. Okay, now what do we have in terms of price action? Well, we've come off the low, but we're still red. Okay, now where would we buy? I'm just going to do that through those two bodies, and then you've got the high just literally above today's open and yesterday's close. So I'll just come through that. It's a round number there as well. Okay, 167.15 is the high. 167.35 would do as an entry. So you're just looking for it to turn blue and take out the high, and that should indicate the end of the accelerated downtrend. Now, in terms of what's a big factor in terms of the way we're viewing this trade is just how far we have moved away from this green line, which is a 20-day moving average, just a middle Bollinger Band, okay? Simple 20-day moving average. Just for those of you who don't know about Bollinger Bands, the orange bands just indicate the volatility, okay? So here, just towards the left of the chart, when you've got all these small candles, look how tight the bands are, no volatility or hardly any volatility. Then you get a move up like here, the bands widen. But look what happens when we have this accelerated sell-off. The bands are extremely wide. Now that indicates there'll be a retracement back to the mean price, the 20-day moving average. It's really just an indication of overbought, oversold, yeah, indicates fear on the downside or greed on the upside. So that level is on the cards, but we think that we should retrace even higher. And I'll tell you why I'm drawing this level in a second. You might have guessed it already. Got a triangle there. For me, you get some up there, down, sideways. Volatility isn't particularly high here. This isn't indication of the short squeeze. That's the short squeeze. Okay, the accelerated move to the downside. So you're basically just going to come in through the round number, clear it, 167.35. The mean is on the cards, but I think we'll run to 174. So it's a long way up, but these types of moves, I've seen them over the years. You always get a good retracement. Obviously, you'll manage the trade as it goes, but for me, it's going back to the mean. If we turn blue, I think that's the exhaustion of selling. Now, where would you put your stop? Well, your stop should be back from 166. I would say 165.30 or 50, well away from the round number in case you get one more spike down, okay? And then look for her to gravitate up. So, you're looking really at nearly 700 pips, okay, possible to the upside. Now, this setup is very, very simple. It's one we would go for very often, okay? And on this one, the risk reward is well over 4 to 1, okay? You don't need to get the majority of your trades right to make money from this type of setup. Now, the way I've done it, I've got a very aggressive entry. That's just my experience. You could leave it a bit longer if you wanted, but I just see no reason to. The risk to reward is so good. So we'll see what happens with this one. But for me, it looks a great trade setup if we get triggered. And if we're wrong, we're not going to lose that much in relation to what we can make. Right, that is the video for today. Thank you very much for watching as usual. Take care. Have a good day.